Hello, everyone. This is Jason Dahl with AFS Financial Group. We are going to go ahead and get started here with It's Not Too Late, Tax and Charitable Giving Strategies under the New Tax Law. I'm going to hand it over to Alp Adebeck here in just a moment. But before I do that, I want to explain that as we go along, in the upper left-hand corner of your screen, there should be like a little control panel, and one of the options should say Q&A. And if you click that, it opens a little chat box where you could type in a question. So feel free to do that at any point during today's presentation. And then, or save your questions to the end. Either way works for us. So I'm going to turn this over to Alp Adebeck to take it from here.
Good morning. If anybody's hearing a little bit of an echo, we have a new phone system, a fairly sophisticated, I'll say internet-based phone system. We've heard when we've been testing a little bit of echoing here and there. Anyway, thank you for joining us. This is Alp, and I'm here this morning with Jason. Some of you might not know this about me, but my first career was a CPA that focused entirely on preparing individual taxes. I want to point out this is not the beginning of a comeback for me. I have no intention on entering the tax business again. When I look back at my life, the day that I exited the tax business is possibly one of the happiest days of my life. As Jason said, our title for today's presentation, It's Not Too Late, Tax and Charitable Giving Strategies under the New Tax Law. A few of the standard tax jokes. In the past, tax reform never meant simplification. The Tax Cuts and Jobs Act of 2018 actually simplified things. The new tax law substantially increases the standard deduction, and as a result, millions of taxpayers will no longer be itemizing their deductions. Overall, while I am a big fan of the corporate tax changes, I dislike many of the basic changes that affect individual taxpayers. And I'll go over that during the presentations. A few facts on our tax system. The U.S. has a progressive tax system, meaning people with higher taxable incomes pay higher federal income taxes. Due to the Tax Cut and Jobs Act, the 2018 tax brackets, tax rates, and standard deduction amounts have all been revised. Taxpayers fall into one of 7 brackets depending on their taxable income. I will say tax rates differ for long-term capital gains, qualified dividends, etc. For individuals, these lower rates are scheduled to expire in 2025. Let's compare the 2017 and 2018 tax brackets. You can see the lower tax brackets to start with in 2018, so that's on the right side of the screen. You see the 10 and 12% brackets there. But one of the things that's interesting, for single people, the 35% tax bracket starts at a much lower level. So if you just compare it from this side, the right side, to the left side, you can see how the 35% tax bracket kicks in at a much lower level. Also, the top bracket at 37% is lower than 2017's top rate of 39.6%. This will result in substantial savings for high earners. We will not be discussing the lower rates for certain flow-through businesses. Also, the new laws minimize the so-called marriage penalty for dual income high earners. So that's actually a big positive on the tax brackets. Fairly straightforward how that works. Here's one of the big changes. In 2018, we have a much higher standard deduction, but you no longer get a personal exemption. So if you look on the left side, we've got the 2017 standard deduction and exemption amounts, 2018 on the right side with no exemption amounts. And so you can see for a single person, the standard deduction is now $12,000 compared to $6,350 in 2017. For married taxpayers filing jointly, a $24,000 deduction versus $12,700. A married couple, both age 65 will now get a $26,600 standard deduction. That's $24,000 plus an additional $2,600 for being 65 and over. So one of the big changes, they have a child tax credit instead of the personal exemption. And keep in mind, a credit is a dollar for dollar offset of your taxes, much more valuable than a deduction. So the child tax credit is being doubled for 2018. The child tax credit is available to be claimed for qualified children under age 17, and you can claim it for all of your qualifying children in a given tax year. One thing to note, the child must be under 17 at the end of the tax year to claim the credit. This is actually a huge tax break for lower income taxpayers with qualifying children. The amount of credits they can get, so if you see for one child, they can get a $2,000 credit, for two kids, $4,000, for three children, and so on. You can just do the math, basically, but a major change here. They also have the family tax credit for older dependents. It's not as generous as the $2,000 tax credit. It's kind of strange how it kicks in at a lower level where there's still a lot of expenses for 17 and 18-year-olds, but basically the family tax credit of $500 kicks in at age 17. The credits phase out, just as the personal exemptions phased out in 2017 and prior years for higher income taxpayers. For a single person, the credit phases out between adjusted gross income of $200,000 to $240,000. The same is true if you're filing as head of household. For married filing joint, the credit phases out between adjusted gross income of $400,000 to $440,000. And something to note again, no real marriage penalty here. So that's a huge positive for that. Changes in itemized deductions. For itemized deductions, I'm going to focus on taxes, interest expense, charitable contributions, and miscellaneous itemized deductions. Back when I did the tax work, those were the four main itemized deductions. It was really rare if anybody got medical expense deductions. So the big change everybody talked about early on, and as Jason and I frequently talk about in meetings, though, there's been a lot of, there's been a lack of discussion about how much it's going to impact people. We kind of characterize it as radio silence on the new tax law. But one of the major changes is state and local tax deductions are now capped at $10,000. So they call this the SALT deduction. Under the new law, taxpayers who itemize will be able to deduct their state income taxes, real estate taxes, and other property taxes up to a limit of $10,000 in total. Again, this is beginning in 2018. Previously, this deduction was unlimited. This severely impacts high-income earners in the high-tax states such as Maryland, D.C., New York, California, Massachusetts, New Jersey, etc. I've got an example here. So if your real estate taxes were $12,000 and you paid $24,000 in state income taxes, that total is $36,000. That deduction is now limited to $10,000. And a major change, and more on the effects of this later. The next change makes no sense to us when you consider that Donald Trump is a real estate developer. They changed the amount you can deduct in mortgage interest. We have new caps on mortgage interest. For homes purchased after December 16, 2017, beginning in 2018, taxpayers may only deduct interest on $750,000 of qualified residence loans. Home equity lines are tied into that same 750 cap, but they actually have a little bit of a change. Home equity lines are only deductible as part of that 750 cap if the debt was incurred to buy, build, or substantially improve the taxpayer's home that secures the loan. In the past, you could have actually paid off personal bills and carried a home equity line of credit, and that interest was tax deductible. I will say, as a former CPA, I have no idea how they're going to be able to track this. On the good news front, they've grandfathered in the old rules for people that had purchased homes with larger mortgages prior to December 16th of 2017. So the old $1 million cap limit is still there. So that's actually one positive. When it comes to charitable contributions, basically no real change here. Under the old tax code, one thing that happened with itemized deductions for high income taxpayers, they basically lost 3% of their itemized deductions due to this phase out once your income got above a certain level. That's actually been eliminated in 2018, but no real negative changes affecting charitable contributions in 2018. This is probably one of the biggest changes, and I'll say it's possibly the easiest one to talk about. Miscellaneous itemized deductions on Schedule A. Essentially, they've been eliminated for tax years 2018 and 2000 and through 2025. So if you look at your tax return for 2017 and prior years, and if you're getting a benefit out of miscellaneous itemized deductions, they actually had to exceed 2% of your adjusted gross income. But if you're going to benefit from that, that deduction is now gone in 2018 through 2025. This affects Schedule A only. It does not affect any deductions you could claim on your business, such as Schedule C, or on Schedule E if you've got rental real estate, any expenses attributed to that. It has nothing to do with that. It's strictly just with your Schedule A miscellaneous deductions. As a result of these changes to itemized deductions, fewer people will itemize. My understanding, it's actually going to be in the millions. Millions of less people will itemize in 2018 through 2025. So it's the combination of the larger standard deduction, the cap on the SALT deductions, and the elimination of miscellaneous itemized deductions will make it very difficult for most people to itemize. For example, for a married couple, they have a standard deduction of $24,000. They have a SALT deduction capped at $10,000. If they have mortgage interest of $10,000 and they gave $2,500 to charity, their total deductions are $22,500, while their standard deduction is $24,000. So in this example, the couple would not itemize. If your house is paid off, there's a good chance you will not itemize because you can take away that mortgage interest deduction. So if you look at that same example, your two deductions would total $12,500. You're nowhere near itemizing unless you were to give a substantial amount of charitable contributions to get over that threshold. And remember, it's only the amount over the threshold that actually becomes, I'll say, an additional deduction. For example, if your total itemized equaled $25,400, in theory, you'd get a benefit of a $1,400 additional deduction as a married couple. We expected this to happen, and it is. It's what I call a giant sucking sound down to Florida, where there are no state income taxes. So this is the fallout from the new individual tax laws. People are leaving the high income tax states. Montgomery County Executive Ike Leggett, this just came out a few weeks ago. He warned of declining tax receipts from wealthy families. A relatively small number of wealthy families have had a huge impact on Montgomery County's finances, as a few dozen residents blew a nearly $80 million hole in the county's projections simply by following the recommendations of their financial advisors. In other words, they didn't say this in the article, these taxpayers either moved to Florida or did what they have to qualify as a Florida resident, meaning they are out of the state of Maryland for more than 6 months of the year. So this to us has major long-term budget implications for the states with high income taxes. Very few people are talking about this. We actually think this is a fairly big negative, and actually talk of this started happening before the law changed. David Tepper, the new owner of the Charlotte Panthers of the NFL, there's a famous story that he moved out of New Jersey in 2015 or 2016. Now, he ran a hedge fund, and I believe some years he was making over $1 billion and paying over $100 million in state income taxes to the state of New Jersey. And the state of New Jersey commented that that one move blew a huge hole in their state's budget in that year. So to us, this is something that we'll see the effects of this longer term as more and more families, high income, high net worth families, consider leaving the high state income tax states. One of the ways that you can tax plan around some of the new tax law changes is by bundling your deduction. In this example, we have a married couple with no children. Normally have itemized deductions of $23,000 per year, which was $13,000 of state taxes, real estate taxes, and mortgage taxes, plus $10,000 of charitable giving. So we have two charts here. So in option one, they take the standard deduction. So in 2018, you see $10,000 of charitable deductions, $13,000 of other deductions, total itemized deductions of $23,000. The standard deduction is $24,000. In 2019, if they did the same thing, in both years, they get a total 2-year deduction of $48,000 with some tax smart planning where they concentrate their charitable giving. In 2018, instead of giving $10,000, if they were to give $20,000, they now have $33,000 of itemized deductions in 2018. If you look at 2019, they stayed disciplined, do not give any charitable contributions in 2019. In this example here, they have total deductions of $13,000, but they still get a $24,000 standard deduction. But in 2018, they got a $33,000 write-off. Their total write-off is $57,000 between the 2 years, so an extra $9,000 of deductions basically by bundling them in 1 year. Some additional tax planning strategies. One way to take advantage of the new tax law, along with just the limitations on charitable contributions, if you can actually donate appreciated securities. And so, for example, if you donate 100 shares of XYZ company worth $7,500 instead of cash, what happens is you actually get the write-off of $7,500, and you don't pay tax on the appreciation of the stock. So, for example, if your basis in the stock is $1,000 and it's now appreciated to $7,500, you get a $7,500 deduction by donating that amount to the charity, and you don't have to pay any tax on the appreciation. Another strategy you can use is consider using a donor-advised fund. And what that is, you basically get the deduction in the year you make the contribution to the donor-advised fund. And so, for example, you could set up your own charitable foundation. And think like Bill and Melinda Gates, they have their own foundation. When you donate money into your donor advised fund, you will get the deduction for donating into the donor advised fund. And let's say, for example, if you were to donate $30,000 of securities into your donor advised fund in 2018, you'll get a $30,000 itemized deduction into the donor advised fund during 2018. However, you don't get any deduction when you actually make the gifts from the donor advised fund to the charities. But this is a big advantage. This is what a lot of the wealthier taxpayers have been doing in the country for years and years. And we've been setting these up for our clients over the last couple of years, and especially in 2018, when we see that they will not really get any benefit out of their charitable contributions because of the new tax laws. So the advantages of using the donor advised fund, we talked about some of these. Planned gifts can be made in the tax year when they are most advantageous. So if somebody is having a really high income year, it might make a lot of sense to donate securities into their donor advised fund to get a large deduction for that year. The grants to the charity can be made at the donor's convenience. The administration and record keeping are handled by the donor advised fund, so it's actually very easy to set up, virtually no cost for setting it up, and you have online and mobile accessibility, so very straightforward. It really is a great way to donate appreciated assets. Another tax strategy we're seeing in 2018, you can consider donating your required minimum donations. You never really talk like that on a presentation. I apologize for that, but consider donating your required minimum distributions to the charity directly. And your RMD basically is the minimum amount you have to give out from your IRA once you turn 70 and a half. And it's fairly straightforward. You make the contribution straight from your IRA to the charity. And what actually happens is the charity gets the money. You're not taxed on pulling money out of your IRA, but you also do not get the deduction. This is a great strategy to consider if you are not itemizing your deductions. And we've seen this really be very advantageous for clients that are over age 70 and a half in 2018 if they are not going to be able to itemize and charity is a big part of their daily lives. This is really a simple way to actually take some of the money out of your IRA and give it straight to the charity in a very tax advantageous way. Our main takeaways: the rules have changed and most people are unaware of how the changes will affect their tax return. Larger standard deductions combined with the SALT limitations will result in fewer people itemizing. Consider bundling your deductions if you will benefit from the strategy. And if possible, in 2018, we think people should get their returns done early in the spring of 2019 to avoid any kind of last-minute filing shock, where we think there's a number of high-income taxpayers that are basically going to be surprised at how the tax law is going to impact them on their 2018 taxes. Also, best advice we can give you, as I've mentioned, I'm a rusty CPA, but consult your tax advisor. We think for a lot of people, especially on the high income side, there's enough changes to the tax law in 2018. It's worth running a projection to see if there's anything that you could benefit from by taking advantage of some of the new tax laws, and also just to prepare you for the, I'll say, possible higher tax bill for certain taxpayers.
So I have a question to that effect, Al. So if somebody does their own taxes, using a TurboTax or Tax Act kind of software, what, just kind of from a practical perspective, how do they go about doing a projection, before actually submitting and filing their return? Is that a straightforward process?
I have actually not. I actually use TurboTax, and I have not downloaded the tax package yet for 2018. But I would actually just download if they have any kind of software that's already set up for 2018 and try to pencil in the numbers in theory. Just enter the numbers with estimates for 2018 and see how the new tax law will affect you. And if you don't know what some of the numbers are going to be from, the changes from 2017 to 2018, just go down your tax return line item by line item and just enter in estimates.
Great, thanks, Alp. And there was another question just about, you talked about donating appreciated securities, and how do you go about picking which securities to gift, and is that something that we can help with? And so, yeah, I can go ahead and answer that question. So, for example, for accounts that we manage, now, of course, an important distinction is to look at the non-retirement accounts. So essentially like your individual or joint investment or brokerage accounts, so not your retirement accounts. And so within those, through our system, we can cherry pick and look at the lots, is what they're called, and find which positions have the lowest basis and in turn the highest gain, and then you can cherry pick those particular securities to donate directly to your charity, or as Alp talked about, into your donor advised fund. And then if you have an account, at a Schwab or Vanguard, etc. as well, either through their online system, you can look that up, or you could contact them on call into their service centers and ask to say, hey, please identify for me the specific lots that have the lowest basis, highest gain, and then utilize those for giving to the charity or donor advised fund. So great, we appreciate everyone's attendance today and the questions we've received. So we are going to wrap it up. We wanted to keep this under a half hour because we know everybody's busy. So I think we're on target there. And so we welcome, if folks have additional questions as a follow-up or want to reach out to us with comments or questions, please give us a call or shoot us an email. We look forward to hearing from you, and have a great rest of your day. Thanks, everyone, and goodbye.